The worst part about a webinar is feeling like I'm talking to myself. I get used to doing our podcast and where I can actually talk to somebody, and it makes a whole lot of difference. Doing these webinars makes me feel like I'm talking to myself, but I am hopefully going to share some good content this evening. We are going to give everybody about 60 seconds past our start time. We're a couple minutes away from the start time, so I'll give everybody an extra minute beyond that just to make sure we can get everybody checked in. So we're about 2 minutes away from starting. Again, our start time is at about 1 minute, and I'll give everybody an extra minute, excuse me, to get logged in, and then we'll get started. I'll actually touch on questions early on in the presentation as far as how I'm going to handle those questions. But I do want to give you the opportunity to provide questions. We may not get to them this evening simply because this presentation, there's a lot of content. It probably will last us about an hour. But I do want to make sure if you do have questions that I can respond to you directly, personally, with those responses or with those answers. I'd love to hear where you're from as well. If you want to post, or we've got people, I know there's going to be attendees from all over the country, so feel free to post where you're joining us from. We're going to start here, and again, just about probably 30 seconds, give everybody a chance to hop on. All right, we're going to get started. Welcome, everyone. I am glad you are here. Today, we're talking about savvy Social Security planning for women. Women represent 56% of all Social Security beneficiaries age 62 and older, and about 66% of all beneficiaries age 85 and older. So, whether you're married, single, divorced, widowed, there are certain strategies you can use to give yourself more benefits or earn more benefits over your lifetime. And we're going to talk about some of those strategies this evening. Now, quickly, just a little bit about me. My name is Eric Blake. Our firm, Blake Wealth Management, focuses on helping women over 55 who are divorced, widowed, or navigating retirement on their own. And that focus on women comes from my own story. I was raised by a single mom and spent a lot of time with my grandparents, but my grandmother was widowed at the age of 62, and she's now 91. We actually have 5 generations of women in our family, with my granddaughter, who is 2 years old. But watching my mother and my grandmother navigate life and money and Social Security on their own is really what shaped how I approach retirement planning. And it's why I'm so passionate about helping women feel more confident about their financial future, no matter what their background is. Now, to say we focus on working with women, we do actually work with couples, but it is absolutely imperative that both spouses are actively participating in the planning process. So if you're wondering why a male advisor would be doing a presentation on Social Security planning for women, this is my why. So these are the 5 generations of women. You see my wife, my mom, my grandbaby, my daughter, and then of course my grandmother, again, 91 years old. So these are the women that inspire me every single day. Now, before we dive in, as always, I have just a couple housekeeping items I want to make sure we take care of. First is this presentation is for informational and educational purposes only. It's not investment advice, legal advice, or tax advice. I always want to encourage you to talk with your own financial advisor, attorney, CPA about your personal situation. Second thing is this presentation is going to last about an hour, maybe even a little bit longer than that. If we don't have an opportunity to get to questions and you did provide a question in advance, I do have those. I will respond by email. If you have questions throughout the presentation, please go ahead and post those in the Q&A. Again, I do receive those by email, and I will respond personally to each one of those. In fact, if you have questions about Social Security filing strategies, eligibility, impact on your retirement plan, or anything else, I'm actually going to share a way we can help get your most important Social Security questions answered before we wrap up. And that's through our complimentary Social Security planning session that we're going to be offering you. But you do have to wait until the end to find out more about that. So let's get into our presentation. So, how confident are you in your ability to retire comfortably? This question was recently posed to 5,900 men and women who are still working. Not surprisingly, women are less confident in their ability to retire comfortably. 42% said they were either not too confident or not at all confident, compared to 29% of men. And women have some very specific fears about money in retirement. The biggest fear is outliving their savings and investments. And then the next fear is that Social Security is going to be reduced or even cease to exist in the future. These are all followed by declining health and the need for long-term care and not being able to meet basic financial needs. Men also have these fears, of course, but just to a lesser extent. Women have made great strides in educational attainment and access to career opportunities in recent decades. Yet, despite this progress, women are still at greater risk than men of not achieving a financially secure retirement. This is a quote that came from Catherine Collinson, CEO and president of Transamerica Institute and Transamerica Center for Retirement Studies. And unfortunately, it's true in too many cases. But at least you're here, whether this is your first step for you or you've done some of the planning already for your own retirement. Gathering information about Social Security and other resources for income in retirement is what you need to do to take care of yourself financially. Now, here are the realities. In general, women have lower lifetime earnings, lower pensions, and longer lives than men. Most are probably aware that the pay gap between men and women and what that represents. On average, women earn about 82 cents for every dollar earned by men. And of course, this then translates to lower retirement savings, lower pension benefits, and lower Social Security benefits. Yet, women tend to live longer than men. So you need these resources even more. Now, that gender pay gap means that a full-time working woman will earn $406,000 less than their male counterpart over 40 years, according to a recent study by the National Women's Law Center. Translated another way, a woman needs to work 50 years compared to a man's 40 years just to break even. And obviously, every situation is different, but I just want to mention the value of working a few more years potentially. By not being in such a rush to retire, you may be able to pay down debt. You might be able to add to your retirement savings, reduce the number of years that you have to draw from your assets in retirement, and potentially raise your Social Security benefits. All right, now let's get into the subject you came to learn about, and that is the value of Social Security and how you may be able to increase your lifetime benefits. So here's one reason why Social Security is so important to many women. It is because it offers income that you can't outlive. Ida Mae Fuller was the very first recipient of a monthly Social Security check, and she lived to 100. She received Social Security right up until the month she passed away. And if your monthly Social Security benefit is $2,000 and you live just 10 more years, you'll receive a total of almost $300,000 in lifetime benefits. And if you live 30 more years, you'll receive nearly $1 million. That's a big number because Social Security provides inflation adjusted income for life. The best way you can get the most out of the Social Security system, of course, is to live a really long life. Now, the previous slide showed the total benefits you might receive depending on how long you live, but this slide shows you how your annual income could grow with those cost of living adjustments. So if your benefit is $2,000 and your annual cost of living adjustment averages about 2%, your monthly income in 10 years will be $2,438. And in 30 years, it'll be $3,623. And so again, when it comes to getting the most out of Social Security, it pays to live a long time. All right, now for the fun stuff, or at least what I consider to be the fun stuff, and that is the Social Security rules and strategies. And these can be somewhat complex depending on your marital status, but it is definitely worth understanding the different rules and strategies because it's what can help you get more out of the system. So let's start with a series of questions. The first question is, do you qualify for Social Security benefits on your own work record? You do if you paid into Social Security for at least 10 years sometime during your lifetime. It doesn't matter if those 10 years occurred all in one early stretch in your life or later in life, or if they were broken up. You just need to get those 10 years of fairly minimal earnings. The next question is, are you currently married? And has your husband started receiving his Social Security benefit? It's going to become clear later why we're asking these questions. You or your husband may be able to receive spousal benefits, and we're going to explain some of those strategies. Now, regardless of whether you're currently married, have you been married before? Believe it or not, you may be able to receive Social Security benefits based on a former husband's work record. So if your previous marriage ended in divorce, and if it lasted 10 years, over 10 years, and if you're currently unmarried, you may qualify for divorced spouse benefits. If you're divorced and your ex-husband is deceased, you may qualify for divorced spouse survivor benefits, and we're going to talk more about that later. Now, even if you're currently married, you could receive survivor benefits based on a former husband's work record as long as your current marriage took place after the age of 60. So don't try to memorize all these rules right now. We're going to explain them in more detail throughout the presentation. So depending on your answers to the previous questions, you could be entitled to one or more of the following: retirement benefits, spousal benefits, divorced spouse benefits, or survivor benefits. How you coordinate all these benefits is crucial in determining how your overall Social Security income is going to play out. So I do want to pause just for a moment and want to talk about some definitions related to Social Security that is going to be important to understand. The first concept to understand is full retirement age. This is the age at which you may claim full unreduced Social Security benefits. A lot of people think of age 62 when they think of Social Security, but if you claim Social Security benefits at 62, it will permanently be reduced by 25% or more. So to get your full benefit, you must wait until full retirement age to claim it. If you were born between 1943 and 1954, your full retirement age is 66. If you were born in 1960 or later, your full retirement age is 67. The next important concept to understand is your primary insurance amount. We're not going to go into how that benefit formula is calculated, but basically your benefit is going to be determined by your work history. Now, the system uses your highest 35 years of earnings to calculate your benefit. The higher those earnings are, up to the annual Social Security taxable maximum, the higher your benefit's going to be. And this is one reason why we encourage women to work a little bit longer if possible. If you've taken time out of the workforce to raise children or go back to school, there may be some zeros on your earnings record. So if you keep working, you may be able to replace some of those zeros with higher earnings and raise your benefits. So to find your primary insurance amount, you just look at your annual Social Security statement. It's your benefit amount at your full retirement age. So in this example on the screen, the benefit amount at full retirement age is $2,119 per month. So again, this is the primary insurance amount, or what you might hear called PIA. Now let's talk about retirement benefits. So if you did work for at least 10 years in a job that paid into Social Security, you will be entitled to a retirement benefit. If you're over 60, the Social Security Administration sends you an annual statement, typically 3 months before your birthday, showing the amount of benefits that you may be entitled to when you retire. If you're under 60, or for any other reason that you want to access your statement online, you can go to the website on the screen, the socialsecurity.gov/my-account. Now, the Social Security Administration stops generating statements for anybody who may already be receiving benefits in some form. You can also access the retirement estimator through the My Social Security account, and this is the method that taps into your work history and gives you an estimate similar to what's on your statement, But there you can play around with some different potential income scenarios to see what the impact might be. And then another way you can use a way to use one of the calculators on the Social Security website. You can see the website there as well. And there's several different types of calculators, some easier, some more complex, depending on what you're trying to achieve by looking at that. Now, we talked about your primary insurance amount, or PIA, which is the amount of your benefit if you apply for Social Security at full retirement age. But obviously, we want to talk about what happens if you apply at a different age. So, if you apply for your Social Security retirement benefit before full retirement age, you will receive a percentage of your PIA. So if your full retirement age is 67 and you claim at 62, you'll receive 70% of your PIA. So if your PIA is $2,000, your permanent benefit will be $1,400. The difference between that $1,400 and the $2,000 may not seem like a whole lot much right now, but over time, claiming early can make a huge difference in the amount of total benefits that you receive, as well as the amount of income you receive each month. Conversely, if you apply for Social Security after full retirement age, your benefit will go up by 8% for each year that you delay. So if your full retirement age is 67 and you apply at 68, your benefit will be 108% of your PIA. At 69, it'll be 116%. And then at 70, it will be 124%. So if your PIA is $2,000 and you wait until age 70 to apply, your permanent benefit will be $2,480. So here are the claiming options. So let's say you turn 62 and your PIA is $2,000. If you apply at 62, your permanent benefit will be $1,400 per month. By age 70, with annual cost of living adjustments, your monthly income will be up to $1,640. Sorry about that. Or you could delay applying until age 70. At that time, your benefit will have grown with the 8% annual delayed credits and the annual cost of living adjustments. If you apply at 70, your income at 70 will be significantly higher than if you apply it at 62. And here we see how wide the disparity has grown. So when you're 85 years old, your monthly income will be $2,208 if you apply for Social Security at age 62, or $3,911 if you apply at 70. And this can make a huge difference in your standard of living. And these amounts in the third column may seem high to you now, but they're not going to seem high when a loaf of bread costs $15 at some point down the road. So just keep in mind that these numbers are based on an annual 2% inflation adjustment. The actual inflation adjustment could turn out to be quite different, as we've seen recently in the last few years. So the when to apply question is very complex, and it really does require a customized analysis. But here are a few points that you can remember. So if you apply early, your benefit starts out at some fraction of your PIA and remains at that percentage for the rest of your life. Your benefit amount is locked in at the time you apply and only goes up with annual cost of living adjustments. Now, keep in mind that cost of living adjustments magnify the impact of early or delayed retirement, because the annual cost of living adjustment is applied either to that lower amount or to the higher amount, and this causes the disparity to increase each passing year. The when to apply question impacts survivor benefits as well. In fact, if your husband earned more than you did so that his PIA is higher than yours, it is even more important for him to delay filing if possible. This will increase your survivor benefit. So if he dies first, his higher benefit will transfer over to you. So you want to do whatever it takes to maximize that survivor benefit. And the way to do that is to have him apply for his benefit at age 70. And we'll talk more about that here in a few minutes. So getting stuck with a reduced benefit is not the only reason not to file for Social Security benefits before full retirement age. Another reason is that if you are still working, some or all of your benefit may be withheld due to the earnings test. So $1 in benefits will be withheld for every $2 you earn over $24,480 here in 2026. Now, this is not a reason not to keep working. You're going to need those extra earnings both now and in retirement if you're managing to save some of that income. But it is a reason not to apply for Social Security before full retirement age. So after you turn full retirement age, there is no earnings test. So you can receive your full Social Security benefit and earn as much as you want from working without your benefits being reduced. All right, so let's talk about spousal benefits. When Social Security was first instituted in 1935, most women didn't work. So the system allows for spousal benefits to be paid where a woman can draw Social Security benefits off of her husband's work record. Now, of course, most women qualify for a retirement benefit on their own record as well these days, but you still may be able to take advantage of spousal benefits. And because Social Security is gender neutral, your husband may be able to take advantage of spousal benefits as well. So let's start with a simple example. So here we have Jack and Jill. They're married. Jack's PIA is $2,400. Jill never worked, so she doesn't qualify for Social Security on her own record. After Jack files for his benefit, Jill can file for a spousal benefit. The amount will be 50% of his PIA if she files for it at her full retirement age. If she files early at 62, it will be 35% of his PIA number. Now, let's talk about how to coordinate your own retirement benefit and your spousal benefit. There are some rules that you have to follow here. And by knowing these rules, you can make them work to your advantage. First is if you file for Social Security before full retirement age, you'll receive your own reduced benefit first. If your PIA is less than 50% of your husband's PIA, you may also receive a spousal benefit, providing that your husband has filed for his benefit. If your PIA is more than 50% of your husband's PIA, you will not receive a spousal benefit. So here's an example. So again, we have Jack, his PIA is $2,400 and Jill's PIA is $800. Jill files for Social Security at 62. Before looking at any spousal benefits, she will be paid her own benefit first. It will be 70% of her $800 PIA or $560. And then let's say Jack is 4 years older and has already filed for his benefit. This now makes Jill eligible for a spousal benefit. So let's see how much that'll be. To calculate the spousal add-on, they'll subtract her PIA from one half of his PIA. So that's $1,200 minus $800, which equals $400. Then that amount will also be reduced for early claiming. So the $400 will be multiplied by 0.65 to get $260. So now adding that together, the $560 reduced retirement benefit and the $260 reduced spousal add-on, Jill will wind up with a total benefit of $820. And actually, you can see that this is less than the 50% of Jack's PIA. And again, that's because Jill filed early. If you file at your full retirement age and you qualify for a spousal benefit, you may receive the maximum spousal benefit, which is 50% of your spouse's PIA. Or if your own benefit is higher, you're going to receive that amount. You'll receive your own retirement benefit. If Jill files for her benefit at her full retirement age, she will be paid her full PIA of $2,000 per month. She will not be entitled to a spousal benefit because her own benefit is more than the 50% of Jack's PIA. Now we come to divorce spouse benefits. So if you are married over 10 years to the same husband and you're currently unmarried, you want to pay attention to this. Here are the rules. So if you are married, if your marriage lasted at least 10 years, if you are currently unmarried, and if your ex-husband is at least 62, you may be entitled to a divorced spouse benefit. If the divorce occurred more than 2 years ago, he does not need to have filed for his own benefit. He only needs to be 62. That's a key difference between spousal and ex-spousal benefits. So here's another example. Here we have Dick and Dora. They're divorced. They were married for more than 10 years. Dora is 62 or older and currently unmarried. Dick's PIA is $2,400. He is over 62. Dora files for her divorced spouse benefit at her full retirement age and starts receiving 50% of Dick's PIA or the $1,200, the 50%. Now, Dick's own benefit doesn't get affected. His current wife's spousal benefit will also not be affected. And Dick's other ex-wives, divorce spouse benefits, will not be affected. So he might have three ex-wives, and if he was married to each one for 10 years, all three ex-wives may receive full divorce spouse benefits off of Dick's record. And his current wife can receive her spousal benefit as well. Now, actually, the Social Security framers probably didn't think about these multiple marriage scenarios, but it actually is somewhat fairly common these days where you might see multiple spouses, ex-spouses, receiving benefits off of the same former spouse. And actually, you want to take advantage of that if that's something you're eligible for. Now, it's important to remember that even if you meet all the requirements for a divorced spouse benefit, if your own benefit is more than half of your ex spouse's benefit, you will not be entitled to a divorced spouse benefit. It is not impossible to take a divorced spousal benefit and let your own benefit grow to age 70. That rule, there was a rule that allowed that in the past, but they did away with that rule a few years ago. Now, however, if your ex dies, the survivor benefit will generally be equal to 100% of the amount he was receiving at his death. So if you meet all the requirements for a divorced spouse benefit, and if this amount exceeds your own benefit, you can switch to the higher amount. And this is why it will be important to keep tabs on your ex in the years ahead. So if he happens to pass away, you can then contact the Social Security Administration to see if you'll be entitled to a divorced spouse survivor benefit that is higher than your own. All right, now let's talk about survivor benefits. And you probably can't really imagine this right now, but if you're married or if you're divorced, your husband or your ex husband might die before you do. And odds are that he will, since women typically, on average at least, live longer than men. So you might at some point in your lifetime become eligible for a survivor benefit. And if that survivor benefit is higher than the benefit you're receiving at the time of your husband's or ex husband's death, you can switch to the higher benefit. So even though it may be a long way off, you really need to understand how survivor benefits work because certain decisions made now can affect that benefit, the amount of that benefit down the road. Now, I want you to follow this carefully because the amount your survivor benefit, it can vary greatly, and it depends on two things. The first factor is when your deceased spouse originally claimed his benefit. This is what is called the original benefit. The second factor is when you claim that benefit. This is called the actual benefit. These two events are usually separated in time. For example, if your husband could claim his Social Security benefit at 62 and then live to be 80 or 90 years old, you won't claim the survivor benefit until he passes away some 20 or 30 years into the future. But the fact that he took his benefit at 62 means it will be much lower than if he had waited and taken it at 70. And husbands don't often think about this when they're 62 and they're deciding when to apply for Social Security. So in this example, Jack's PIA is $2,400 and he passes away at 70 or later. The original survivor benefit will be $2,976 if he had claimed his Social Security benefit at 70. This is because his benefit will include 3 years of 8% annual delayed credits to bring the $2,400 up to $2,976. Or it will just be $1,980 if he had claimed at 62. So actually, if we ask you this question, do you think Jill would rather have a survivor benefit of 2,976 or 1,980? Unless she's crazy, she'd opt for that 2,976. So what does she need to do to make this happen? She needs to get Jack before he turns 62 and tell him to file for his Social Security benefit at 70, not 62. This is why we talk about women really should be the Social Security decision maker for most families, because the age at which Jack files for his benefit will directly affect Jill's survivor benefit. So she's really the one that should be making that decision. Now we get to Jill's actual benefit. And we've already seen that the original benefit could be anywhere from $1,980 to $2,976, depending on when Jack filed for his benefit. So let's say that Jack has died and Jill is wondering when should she apply for her survivor benefit. If she's over 60, she can apply at any time. In fact, if she goes to her Social Security office and tells them that Jack has died, they will probably encourage her to go ahead and apply for her survivor benefit right then. Social Security, the workers at the Social Security Administration, they're in the business for helping people get all the benefits they are entitled to right now. But from a long-term perspective, this may not be the best move. The amount you start with is the amount you will stick with throughout your life. So sometimes and often it will pay to start with the highest amount possible. As we can see on this table, if Jill applies for her survivor benefits at age 60, she will get a fraction of the original amount, just $1,716 per month. And we can also see that if Jack applied for his benefit at age 62, Jill will get a much smaller survivor benefit regardless of when she claims. The most she can get is $1,980. But if Jack had claimed at 70, and if Jill claims her survivor benefit at her full retirement age or later, she can get as much as $2,976. So as you can see, there's a huge disparity in these benefit amounts from a low of $1,716 to a high of $2,976, depending on the decisions that they make. And these decisions will determine Jill's standard of living much later in life. As I said just a second ago, survivor benefits can be claimed as early as age 60 or even 50 if you're disabled. But remember, if you claim at 60, the amount will be reduced. So young widows shouldn't automatically file for their survivor benefit as soon as they turn 60. You need to analyze all of your Social Security claiming options before deciding when to file. To qualify for a survivor benefit, you must have been married to the person who passed away. Living together doesn't count. If he died during the marriage, you only need to have been married for 9 months. If he died after you divorced, that marriage must have lasted at least 10 years. By the way, this also applies to same sex couples who can also get Social Security benefits if they are or were legally married. So, when planning ahead for when you might be on your own, remember that you can receive the higher of your survivor benefit or your retirement benefit, but not both. So if Jack is receiving $2,976 and Jill is receiving her spousal benefit of $1,200, let's say she doesn't qualify for Social Security on her own record, she can jump up to Jack's benefit of $2,976 after he dies. But her $1,200 will stop. Jill should plan ahead for this loss of income, and actually, those are things we can help with. If your ex-husband dies, and if you are either unmarried or you married and the marriage took place before or after the age of 60, excuse me, after the age of 60, you may qualify for a divorced spouse survivor benefit. And a lot of women won't think about this, especially if they were married and the divorce happened many years ago. But for example, let's say we have Sam and Sue who were married from 1970 to 1985. Sam died in 1995. Sue has not remarried. As soon as she turns 60, she will become eligible for a divorced spouse survivor benefit. Remember, though, if she starts at 60, it's going to be reduced. So she might want to wait until she turns full retirement age. So just to summarize what we've been talking about. So if you think you might outlive your spouse or your ex-spouse, and odds are that you will, you want to encourage your spouse to wait until age 70 to start his Social Security benefit. Then you want to claim your survivor benefit at your full retirement age or later. Hopefully, you'll be well over full retirement age when your spouse passes away. but just keep this bit of information in mind. And then you want to coordinate your survivor benefit with your own retirement benefit. Now, let's talk about how to coordinate survivor benefits and retirement benefits. And remember, you never know when you might become eligible for a survivor benefit, so it's worth tucking this information away for when you might actually need it. So, what if you qualify for both a retirement benefit and a survivor benefit? This will be the case for most of you. Now, if you and your husband are well over 70 when he dies, it will be straightforward, just a straightforward matter of taking the higher benefit. You'll either switch to your husband's benefit and yours will stop, or his will stop and you'll keep receiving your own benefit. So, what I'm talking about here now is if you are under age 70 and qualify for survivor benefits now, either because your husband has passed away or your ex husband has passed away and you were married for over 10 years. And you also qualify for Social Security benefits on your own work record. So, what you can do here is switch from one benefit to another, but you have to be strategic about it. You could start your own benefit at 62 and switch to your survivor benefit at full retirement age, or you could start your survivor benefit at 60 and then switch to your own benefit at age 70. Which of these two strategies you should do will depend on the respective amounts. But what you want to do is take the higher benefit last. This will be your permanent benefit, which you'll receive into your old age. So you want to maximize it as much as possible. So if you're in this situation, we can actually help you analyze your claiming options. So if the survivor benefit is higher than the retirement benefit, you'll want to take the retirement benefit at 62 and switch to the survivor benefit at full retirement age. So in this example, Linda would start her own benefit of $700 at 62 and then switch to the full survivor benefit of $2,200 at full retirement age. Conversely, if the survivor benefit is lower than the retirement benefit, you'll want to take the survivor benefit at 60 or as soon as you become eligible for it, and then switch to your benefit, to your retirement benefit at age 70. In this case, we have Dora. She has a high PIA. Her survivor benefit is $1,800, which is less than her own benefit. So she claims her survivor benefit at 60 and receives the reduced amount of $1,287 from age 60 to age 70. When she's 70, she switches to her maximum retirement benefit of $2,480. Now, note if you are still working and you're under full retirement age, all or part of your survivor benefit may be withheld because of the earnings test. If you're divorced or widowed and thinking about remarrying, here are the rules you want to keep in mind. So, if you remarry at any age, you can't receive divorced spouse benefits. So if you're already receiving divorced spouse benefits and thinking about remarrying, just understand that your divorced spouse benefit will stop. However, you may be able to get spousal benefits based on your new husband's record. If you remarry before age 60, you can't get survivor benefits or divorced spouse survivor benefits. If you remarry after age 60, you can still get survivor benefits or divorced spouse survivor benefits. And I know these rules seem hard to keep straight. And again, don't try to memorize these. If you have questions, please feel free to ask us, or you'll want to contact the Social Security Administration. Okay, here's a summary of survivor planning if your spouse or ex-spouse is still living. If you're married, encourage your spouse to delay his benefit to age 70 if possible. As for your own benefit, you'll want to consider your spouse's life expectancy. If your spouse has some health problems and may have a short life expectancy, you could go ahead and claim an early benefit on your own record because you'll be switching to your survivor benefit at some point in the future. On the other hand, if your spouse is in good health, has a good long life expectancy, you should try to maximize your own benefit by delaying to age 70 because you'll receive it for many years before switching to that survivor benefit. And this will actually help you maximize your income to you as a couple while you're both alive. If your spouse or ex spouse is already deceased, do what we talked about earlier. Compare your own benefit to your survivor benefit and take the highest benefit last. To preserve your survivor benefit, do not remarry before age 60, no matter how much you might love the guy. Obviously, you want to do what you want, but just remember that if you remarry before age 60, any survivor benefits you may be entitled to from a previous spouse's record will not be available to you unless the remarriage ends in the future. Okay, so here's a summary of the strategies depending on your marital status. So if you are currently married, coordinate your benefits with your spouse. To optimize your benefits, one or both of you would delay the start of your benefits to age 70 in order to maximize those 8% annual delayed credits. If you're entitled to a spousal benefit, you can file for it as soon as your husband files for his benefit, providing you're at least 62. Again, remember your own benefit must be less than half of his in order for you to get a spousal benefit. You can't take a spousal benefit until he files, and he'll want to wait until age 70 to maximize his benefit for himself while he's alive and for you after he passes away. In this case, the delayed credits he would get later on are worth more than the spousal benefits you would get right now. If you're divorced, consider maximizing your benefit by delaying it to age 70. Keep tabs on your ex and claim your divorced spouse survivor benefit when the time comes. If you're widowed, coordinate your retirement and survivor benefits. Take the higher benefit last. If you've never been married, you're on your own with no help from spousal benefits, you'll want to consider maximizing your own benefit by working as long as reasonably possible and then applying for Social Security at age 70. Now, regardless of your current marital status, if you have a former spouse who's deceased, consider that survivor benefit as a possible resource as long as you did not remarry before age 60. And again, I know this is a lot to remember. If nothing else, I hope you've at least opened your eyes to some of the possibilities with Social Security. You may be entitled to more benefits than you realized. For help with your individual situation, you can either make an appointment to talk to us, or again, you can call the Social Security Administration. Just be aware that the Social Security workers don't always take into consideration your longer term financial plan. They're often going to recommend the strategy that will give you the highest benefit right now. And again, that's not always what you want. So let's walk through our key takeaways so far. Actually, you could live to age 95, maybe even 100. It's not so far fetched today. Many women should probably be arranging their financial affairs to keep their income flowing just in case you do live to age 95. Social Security is one of the best income sources because it provides inflation adjusted income for as long as you live. The decisions you make in your 60s will determine the amount of income you have in your 70s, 80s, and 90s. The difference between early and late claiming will grow as annual cost of living adjustments cause the higher amount to grow faster than the lower amount. Delaying the start of benefits will give you more income later in life. Coordinating spousal and survivor benefits may give you extra income while you delay your main benefit. But Social Security decisions should not be made in isolation. Social Security alone is not enough income for most people. So you should make your Social Security decisions within the context of your overall retirement income plan. So we're getting close to the end of our presentation. I just want to touch on the basics of Social Security taxation. And just keep in mind, this could be a topic for its own presentation. Because it is such a complex topic, before we get into the basics, I want to share a podcast episode if you would like to take a deeper dive into how Social Security is taxed and the strategies around that, including the impact of the new tax law. And I'll pause here just for a second if you'd like to scan the barcode. Ever since 1984, Social Security benefits have been subject to some level of taxation depending on your other income. This table shows you the taxation of Social Security benefits based on the various income levels. And income in this case means what's called provisional income, which is going to include adjusted gross income plus one half of the Social Security benefit plus any tax exempt interest. And there are different thresholds depending on whether you're single or married finally jointly. Now, one of the things I want to touch on here, tax exempt interest, that is typically going to refer to municipal bonds, municipal money markets, or what you might have thought were federally tax free income sources. But they actually get added back in for determining the taxation of your Social Security benefits. Now, what doesn't, when we're talking about tax free income sources, if you qualify for tax-free distributions from Roth IRAs, that does not go towards your provisional income. So from a tax planning perspective, that's a key note to be aware of. And again, note that these income thresholds were never adjusted for inflation. These are the same exact thresholds that have been in place for many years. So more and more people have been required to pay income taxes on their Social Security benefits. The important thing to remember here is that up to 85% of your Social Security benefits may be subject to tax depending on how much other income that you have. Now, it's also important to note that there's still some confusion around the new tax law, and it did not eliminate taxation on Social Security benefits. The new age 65 plus deduction of $6,000 per qualifying individual simply reduced the number of individuals that have to pay tax on their Social Security. The taxation of Social Security benefits did not change. We're not going to go directly into discussing the new tax law as part of this presentation, but I am more than happy to take questions if you want to email those to me. I'll be more than happy to respond back to you directly. Lastly, it's also important to know that the age 65 plus deduction expires at the end of 2028. Again, all the more reason to understand your options and strategies around the timing of when you elect to start your Social Security benefits. Now, before we move on, I also want to introduce you something that's called the Social Security Tax Torpedo. It's not an official IRS term, but it describes what happens when taking an additional income in retirement causes your taxes to increase more than what you may have expected. Specifically, it happens when the withdrawals from retirement accounts cause more of your Social Security to become taxable at the same time. So most people assume that if they withdraw an extra $10,000, they simply pay tax on that $10,000. But in many cases, the impact is actually much larger than that. And I want to show you what that looks like in real life. So I'm going to walk you through scenario one. This example shows a single individual, age 65, receiving $30,000 per year in Social Security and taking $40,000 from their IRA. Now, this probably means this lady has about $1 million in retirement and investment assets, a good lifestyle, but not to the point where the wrong decision won't have some negative impact on her. So this creates $38,000 of taxable income, $38,200 of taxable income, keeps them in the 12% tax bracket after the new age 65 deduction and the standard deduction is applied. And this is the baseline situation, really nothing unusual here. There you see the 12% tax bracket. Now let's see what happens if we simply add an extra $10,000 in distributions from their IRA account. We see that their IRA withdrawal, the total withdrawal goes from 40,000 to 50,000. Social Security stays the same. So actually, we're receiving the exact same Social Security benefit amount, but now you can start seeing the impact. That additional $10,000 IRA distribution increases how much of the Social Security is going to get taxed based on those provisional income rules I showed you just a bit ago. We keep moving forward. Now we've gone from adjusted gross income from 62,350 to 75,500. And you'll also note not a big deduction, but actually a slight deduction to the age 65 plus deduction because it's also pushed this person above an income threshold where your age 65 plus deduction can actually start getting reduced, even potentially eliminated if your income is too high. But now you see taxable income is now 51,380. Not only that, she's now in the 22% tax bracket. All from simply taking an extra $10,000 out of her IRA account. That was the only change. So why does that tax torpedo hit so hard? A single $10,000 IRA withdrawal doesn't just add $10,000 of taxable income. It sets off something of a chain reaction that amplifies the tax impact far beyond what many people expect. So the first thing that happened is more of the Social Security becomes taxable. That extra IRA income pushes $3,150 more of Social Security into taxable income. So the effective income increase is $13,150, not just the $10,000. We also saw that the marginal bracket jumps from 12% to 22%. So she went from the 12% tax bracket up to the 22% tax bracket, and the new age 65 plus deduction got reduced by just a little bit. So at higher adjusted gross income causes the additional deduction to phase down by adding slightly more AGI, a subtle but real cost of this torpedo effect. What about the future of Social Security? Let's talk about that, and then we'll get close to wrapping up here. Social Security was designed as a what they would call a pay-as-you-go system. Payroll taxes from current workers go into a trust fund and are immediately paid out to current retirees. Because baby boomers have been in their peak earning years, the trust fund has accumulated more than needed for current benefits. And right now, the trust fund holds about $2.7 trillion, which is invested in these special issue treasury securities. As baby boomers continue retiring, these trust fund assets will gradually be drawn down. And just for clarification, the trustees report comes out around June of each year, which is why we have the 2024 numbers here. So over the next 75 years, costs will begin to exceed income. There are enough reserves that the system will be able to pay 100% of promised benefits until 2034. After that, if nothing is done to reform the system, income will be sufficient to cover just 81% of promised benefits. Now, although the Social Security system is not in imminent danger, I think most of us would agree that doing something sooner rather than later is preferred. And here are just a few of the ideas that have been proposed. First thing is to increase the maximum earnings subject to Social Security tax. So in 2026, if you make more than $184,500, you don't pay Social Security tax on the amounts above that. So possibly raising that or even eliminating that cap might be one possible solution. Another reform proposal calls for raising the full retirement age. Actually, you can see that if you're born in 1960 later, 60 or later, your full retirement age is 67. So maybe they're talking about raising it to, say, age 70. There's also another reform proposal that would change the benefit formula so that future increases would happen at a slower pace. Actually, this would affect the benefits of future retirees most likely. And there's also some talking about changing the formula for cost of living adjustments, and this would give retirees smaller benefit increases going forward. Now, given that there are lots of ways Social Security system could be reformed, Congress is likely to address this issue. Are they likely to address this issue this year? Probably not. Obviously, we have a lot of other issues taking priority. And because of that $2.8 trillion trust fund, benefits are not in immediate danger. The last time Congress made major changes to the Social Security system was in 1983, and the trust fund was in just a few months of running out of money. Theoretically, at least, Congress has until 2034 before they have to worry about anything happening. And again, that's exactly why Social Security and retirement income planning should not be made in isolation. The timing of when you claim benefits and where you take your income from in retirement can have significant impact on how much you keep after taxes over your lifetime. Now, as a thank you for joining us for this presentation, I want to offer a few free resources to help you take the next step in your retirement planning. First thing is we're going to be offering a complimentary Social Security checkup. And working with clients on Social Security, we found that sometimes people miss out on benefits because they didn't know they could actually claim them or that they were eligible for certain benefits. Here are just a few examples that might ring a bell. Here's a situation that's not too terribly uncommon. We have a married person who never added her spousal benefit after her husband filed. For example, in doing Social Security checkups, we would look to see if the lower earning spouse's benefit is significantly lower than 50% of the higher earning spouse's benefit. And this could suggest that the lower earning spouse filed first and claimed her own smaller benefit. And then sometime later, after her husband filed the benefit, this would entitle her to a spousal benefit, which would be added onto her own smaller benefit, but she would have to apply for the spousal benefit, which she may not have known to do. And our Social Security checkups will reveal these things like this. Another one is a divorced person who didn't know she could claim a spousal benefit off her ex spouse. Now, not everyone can do this because your own benefit must be less than half of your ex's. If you've been working, your own benefit is probably going to probably exceed your divorced spouse benefit, but it is always good to check. And our Social Security checkups can help divorced people find out if they're receiving all the benefits that they may be entitled to. Here's another one. Divorced person whose ex spouse has passed away. Sometimes ex spouses don't always keep track of each other. But if a person was married over 10 years to an ex spouse that has passed away, she may be able to get a survivor benefit based on that ex spouse's earnings record, which is higher than her own benefit. And these are not limited to women, of course. Social Security is gender neutral. Divorced men can also claim benefits on ex spouse's work records as well. So if you are interested in getting your most important Social Security questions answered, wondering what you're eligible for, exploring and comparing potential claiming strategies, or maybe more importantly, how Social Security fits into your overall retirement income strategy, you can schedule a free 1 hour Social Security planning session once we've wrapped up. You're actually going to be taken to our landing page that will allow you to schedule if you'd be interested in that. As another thank you for attending our presentation this evening, in a follow-up email, I'm going to be sharing our 2026 Social Security Quick Reference Guide. This is a 2-page guide that will include all the key numbers we've discussed during this presentation, as well as a number of other key numbers that may help you in planning your Social Security and retirement strategy. Last thing, one way we are able to help our clients and our broader community stay informed is through the Simply Retirement podcast. We talk about everything from Social Security timing to taxes to real life decisions that women like you are making every single day. So on the screen, you'll see a QR code that takes you directly to our podcast website. Feel free to scan it now, or after the session, we'll provide a link there as well. It is a great way to keep learning at your own pace on your own time. So I'll give everybody a minute there. All right, so this concludes our presentation. If you take one thing from this presentation, it's that Social Security is too important for guesswork. The wrong decision can truly cost you thousands of dollars over your lifetime. As a reminder, if you provided a question in advance, hopefully those questions have been answered as we've gone through this presentation, or if you shared a question during the presentation, again, those questions are going to come to us by email. I will personally respond to each and every question that came through. If you'd like to schedule that 1 hour complimentary Social Security planning session, you're going to be taken to our scheduling page as soon as you exit out of the presentation. And I'll also provide a link in the follow-up email. Thank you so much and have a great night.